We had a decent session today. Dow gaining 216 points, S&P climbing 0.95%, the Nasdaq jumping 0.73%. But what really matters is that we got yet another red-hot consumer price index number. It makes it untenable for the Federal Reserve to keep interest rates this low. From now on, the only question is the pace of the rate hikes and the tone of the Fed's language. Now, the bulls have to be heartened that the market didn't fall apart when these numbers came out, and instead actually rallied with the S&P having a record close. Pretty extraordinary, if you ask me. But maybe the positive reaction is, well, too bullish in light of events to come, and that's why our game plan for next week actually starts all the way on Wednesday when I start discussing it, because that's what matters the most, because Jay Powell holds his press conference after the open market committee meeting. Last time we heard from Jay, he said he'd stop describing inflation as transitory and speed up the tapering of the Fed's bond buying program. Tapering, just forget this term from now on. What we're talking about now is rate hikes. Going forward, I think he'll move up the timetable for rate hikes. We just don't know the cadence of those rate hikes. If Powell says it's time for a series of lockstep rate hikes, then today's rally was definitely premature, and the stock market's going to get hammered. I want you to keep that in mind. But if he traces out the inflation and separates what can be controlled from what can't be controlled, then he may spare us from a term you're going to start hearing a lot starting next week. And it's chiefly going to be said by hedge funds that are short the stock market. And that is that we may be having a crash landing. Yes, that's the term you're going to hear. It's going to be a crash land. These are from people who are typically short the stock market. We've seen enough macro numbers and spoken to enough executives to know that inflation is now rampant, though, which means the Fed really does have no choice to act. However, as I'll explain later, that doesn't mean you should sell everything. The market can rally when the Fed's tightening. It just means different groups will go in and out of style in the Wall Street fashion show. We'll have more on the impact on stocks of during rate cycles just to prove to you that real money can be made in them by owning certain kinds of stocks, and so that you don't just fear the Wednesday to come or the millions of other Wednesdays that we're going to see. Now, I convened an investing club meeting yesterday where I laid out a recommended list of stocks that can handle a new rate hike cycle. What works? You want to own boring companies that make stuff and sell that stuff at a profit, and ideally return some of those profits to shareholders in the form of dividends or buybacks. In other words, this is not the time to own a bunch of conceptual stocks with rapid revenue growth but no earnings. The market has lost its taste for anything intangible. Instead, Wall Street's circling the wagons around steady, solid tech names. Names like Broadcom, which we own for the Charitable Trust, or Oracle, both of which exploded higher today after reporting magnificent quarters. And with that in mind, what is the game plan away from Jay Powell for next week? Right, Monday's a great example of exactly what I'm talking about. One of my favorite drug companies, Regeneron, will have an investor event at the American Society of Hematology's annual meeting, where they'll showcase a growing portfolio for that space that includes bispecific antibodies, RNA-based therapies, and gene editing. Whoa, a mouthful. I think the stock's definitely worth owning away from the conference, but it is going to be a clarion call to what they've got going. Although Regeneron's a biotech name, it's very profitable, and the stock trades at a ridiculously low price-to-earnings multiple. That makes this tangible, not conceptual, because it trades on earnings, not sales or future pipeline prospects. So if Regeneron tells a great story, I think the stock will be rewarded and it breaks out to an all-time high. If we're losing money, I would just say pass. I wouldn't even mention it in the game plan. But it's not. It's making money. It's making money hand over fist. Now, I've said over and over again that we're living through the roaring 20s. This is a boom economy, people, and the vast majority of companies are doing very well, except the ones that lack the ability to raise prices or lack the inputs needed to make their products and have to pay up for them. So one of these challenged companies is a company you all know. It's called Campbell Soup. And it struggled with raw costs and sales growth when reported this week. But they have an investor day next Tuesday. Now, we know that Hormel, the maker of Spam and Skippy and Peanuts, was able to push up prices, and the stock did quite well. Campbell's right now apparently isn't part of that club, but maybe they can be. While this stock is cheap, it's not cheap enough unless management can lay out a story of innovation, along with data showing that they can get away with raising prices. I'd love it if Campbell Soup could pull it off. I'm not holding my breath. Judging from the quarter, you may just have to listen to the event as an explainer, not a catalyst to buy. But I am, as always, open-minded. I certainly wouldn't want to miss Hormel. Talked about that with Jeff Marks and Zev Hema from the Investing Club, saying maybe we got to put Hormel in the bullpen if it comes down to perhaps buy it for the club because they're doing so well. and they're a dividend aristocrat. We're going to talk about that next week. Now, we know Wednesday is Fed Day, where the language of the Fed's statement and the Powell's press conference will be closely scrutinized. I can't read Jay Powell's mind. I have tried. But there's one thing I can predict perfectly. Regardless of what he actually says, there'll be people who come on air arguing that it's very, very bad for your portfolio and you're going to lose money. These people don't know history and tend not to know your stocks either. Don't take them too seriously. Wednesday night is a good example. We're going to get earnings from Lennar, the big home builder. People are going to say you can't own home builders after the Fed starts raising rates. That's wrong. That's very wrong. Regular viewers know that I'm a huge fan of Toll Brothers, but I also like Lennar, and I bet it will report a terrific set of numbers. However, because it's coming on Wednesday night on the heels of the Fed meeting, I expect the stock to get dinged. Yet we know the demand for homes is at an all-time high. We know Toll Brothers was terrific. We just heard from them. So if Toll stock gets hit off of Lennar, you have my blessing to do some buying, as long as the Federal Reserve doesn't get too punitive. If Jay Powell starts talking about a series of lockstep rates, then, we're not going to want to own that at all. Also on Wednesday, Eli Lilly holds its investor meetings. Now, it's the first in ages, and Eli Lilly is an expensive stock on future earnings. As I told members of the investing club, though, at our meeting, I bet we'll get good reads on a number of drugs, one for diabetes, which also has a good component against obesity, and one for Alzheimer's that I think is substantially better than Biogen. And I do a lot of work with the American Migraine Foundation. I've done some work with the Brain Foundation. I think I know whereof I speak. These could be potentially multi-billion-dollar, not million, billion-dollar franchises. We own Lilly for the Charitable Trust, and while I don't know how positive they'll be at the investor meeting, they can be coy. I think the long-term prospects are just terrific here. It's worth buying. Thursday morning, we hear from two amazing companies, Accenture and Adobe. Accenture is the consultant that helps businesses become tech-savvy. They'll onboard you to the cloud. They know all the players. The stock always trades erratically in the wake of earnings and then settles down by the end of the day. So if you don't own it yet, I would wait for the usual buying opportunity before it starts climbing again. Adobe's one of those tech names that's so solid, you got my blessing to own it, because it's a heck of a lot more tangible than most cloud names, similar to Salesforce or NVIDIA, both of which we own for the trust. However, I'm begging you to not own too many high-priced earnings multiple stocks here, because they do tend to act anemically during periods of Federal Reserve tightening. After the close, FedEx reports. You know what? I'm thinking about this and thinking about this. And as far as I'm concerned, this has got to be the single hardest stock to predict the outside of tag of what it will do next. I wish I could recommend it because I admire the team, but I don't have that kind of conviction because I found myself in the coffee grinder every time I think I've figured FedEx out. Sometimes it's just better to tell you at home, I don't know. Now, we haven't talked COVID, but they'll certainly be talking about it when Darden, the parent of Olive Garden, gives us the results on Friday. The restaurant business is making a big comeback, but not all of them. And you don't want to be levered to a company that can't afford to spend on technology or workers anymore. Darden's got deep pockets. They can afford to win in this industry. So I'm looking for a very solid report when they report Friday. Here's the bottom line. We've got a clear setup next week. If you want to trade, you're betting on whether Jay Powell steers us toward a soft landing or a hard landing on Wednesday. But if you want to invest, you should use the inevitable Fed freakout to get some better entry points to some high-quality stocks that have great longer-term prospects. Let's take some calls. Let's start with Matt in New York. Matt.
Booyah, Jim. How are you?
I am doing well, Matt. How about you?
I'm doing well, my friend. Thank you. Appreciate everything you do for all of us investors out here.
Thank you, buddy. Thank you very much.
Jim, wanted to get your thoughts. I noticed today, I've loved this stock before, infrastructure. I liked it during infrastructure, and now that we're past the bill, I still like it. It seems like there's a vast array of opinion on it. It's Caterpillar, CAT.
Yeah, there really are. There are people who think that the raw-cost metals are going to hurt them. There are people who think it's only levered to China and China's slowing. There are people who think it's levered to China and China's cutting interest rates. It's levered to infrastructure, and therefore it's got to be doing what. Here's what it's levered to, okay? Great management that does very well when there's a lot of economic activity. When the Fed starts raising rates initially, there is still a lot of Fed economic activity. And by the way, they do have infrastructure, but they're really linked to oil and gas. It's a good story. I like Nucor more, the steel company, but Caterpillar's a good story. Let's go to Eric in Washington, please. Eric.
Hey, Jim, a nation's capital. Booyah to you. How are you doing?
I am doing well, Eric. Thank you for asking. How about you?
I'm doing wonderful. About to enjoy the holiday season.
Yes.
So speaking of which, I bought some shares on a whim of a company I'm not all that familiar with. I wanted to get your opinion on Ralph Lauren.
All right. Now, I am actually very close to this company. Actually, I'm probably one of the few people who really, I would like to think, has a very good relationship with them. Not to know anything other than what's public, but I really have studied the company. And the reason I mention that is because it's insane that it's at 122. That last quarter was good. I think people didn't understand it. They like Capri more. They like PBH more. RL is a solid buy, and I want you in. The only one that I think is more mispriced is Williams-Sonoma. I'm going to deal with more of that next week because I'm starting to get annoyed at the sellers. They better get out of the way. I got something to say to them. Right, and we got a clear setup next week. Use the Fed freak out to your own advantage. Check out some of the recommended list stocks we have from the Investing Club, and I think you'll do quite well. Mad tonight. Deck the halls with barrels of profits. I'm talking to the king of decking, and that is AZEK, A-Z-E-K. Get a read on the housing sector, company's top brass, and why the stock seems to be stuck in a range. Then yesterday, we held our inaugural Investing Club event. So I'm recapping the event and taking more questions from club members. That's my favorite part of what I do. And potential rate hikes have investors on high alert. But I'm using history as a guide to help you prepare your portfolio for when the moment arises so you don't panic, which is not a strategy. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.